Understanding operating earnings, a key metric for business profitability. In the realm of corporate finance and accounting, understanding various metrics that reveal a company's financial health is essential for both internal and external stakeholders. One such crucial metric is operating earnings. This article will delve deeper into what operating earnings are, their significance, how they are calculated, and their relationship with other financial metrics. What are operating earnings? Operating earnings isolate the profits realized from a business's core operations. Specifically, this term refers to the amount of profit generated from a company's revenue after subtracting expenses directly associated with running the business. These expenses may include cost of goods sold, COGS, direct costs attributable to the production of the goods sold. General and administrative, G&A, expenses, overheads not directly tied to the manufacturing of goods or services. Selling and marketing expenses, costs related to promoting and selling the products or services. Research and development, R&D investments made to innovate and improve products or services. Depreciation, the allocation of the cost of tangible assets over their useful life. Operating earnings provide a clear picture of how well the company is generating profits from its everyday business activities, excluding non-operating expenses such as interest payments and taxes. Why are operating earnings important? Operating earnings are a valuable measure of corporate profitability for several reasons. Core business focus. By filtering out non-operating expenses, stakeholders can assess the performance of a company's primary business operations. Comparative analysis. Operating earnings allow for comparison with industry peers, as they provide a clearer lens into operational efficiency and profitability. Trend analysis. Over time, management and investors can track operating earnings to forecast potential earnings stability or volatility. Key takeaways. Operating earnings reflect profit from a company's core operations. It provides a clearer financial picture by excluding taxes and one-off items that may distort net income. A related metric is operating margin, calculated as the ratio of operating earnings to total revenues. How to calculate operating earnings? Operating earnings are typically reported at the bottom of a company's income statement, just prior to net income. The general formula for calculating operating earnings is as follows. Text, operating earnings, equals text, total revenue, text, operating expenses. Example of operating earnings. To illustrate, consider Gadget Company, which reports the following figures for a specific quarter. Total revenue, $10 million. Operating expenses, $5 million. Interest expense, $1 million. Taxes, $2 million. From the data, we can calculate 1. Operating earnings. Text, operating earnings, equals $10 text, million, $5 text, million, equals $5 text, million. 2. Operating margin. Text, operating margin, equals text, operating earnings, text, total revenue, equals $5 text, million, $10 text, million, equals 50%. 3. Net income. Text, net income, equals text, operating earnings, text, interest expense, text, taxes. Equals $5 text, million, $1 text, million, $2 text, million, equals $2 text, million. Operating earnings versus operating margin. Another critical metric that stems from operating earnings is the operating margin. This is defined as the operating earnings divided by the total revenue, expressed as a percentage. Its calculation provides insights into how effectively a company can convert sales into profits, allowing both management and investors to compare profitability across different companies and sectors. Special considerations. Sometimes, companies present a non-GAAP adjusted operating earnings figure. This seeks to account for one-off, non-recurring costs that management believes should not reflect ongoing operational performance. Non-GAAP earnings. These figures deviate from generally accepted accounting principles, GAAP, to provide a clearer picture of recurring operations. Restructuring costs. Commonly seen in corporations undergoing significant changes, these expenses might be recorded in a way that some critics argue they should not always be considered as non-recurring. Conclusion. Operating earnings are a fundamental aspect of corporate financial analysis, serving as a key indicator of a company's operational performance. By understanding this metric along with its relationship to other financial ratios, stakeholders can make more informed decisions about the company's profitability and operational efficiency. Whether for internal management use or external analysis by investors, operating earnings remain a vital sign of a company's financial health.